Welcome back to the Daily Gold University. If you have completed all of the other 11 lessons, I congratulate you on completing the first round or the first level at the Daily Gold University. In this video, we have a special bonus lesson, which includes a number of charts that did not fit into the other lessons. And these are charts which we think will have great value to you. Let's get to it. In this bonus lesson, we share important charts that were not included in the other chapters, but must be included because they provide additional valuable information. In bonus figure 1, we plot various bull markets, including gold from 1970 to 1980 and 2000 to 2011, on the scale of the current move in gold, which began at the end of 2015. Gold would be closer to the pack if we had started the move in August of 2018 rather than at the end of 2015, but I digress. In bonus figure 2, we compare the performance of gold stocks from the bottom in 2016 onwards with that from 1960 to 1980. The data is from the Barron's Gold Mining Index. The current Barron's Gold Mining Index appears materially stronger than the various gold mining indices, QE, GDX, etc. However, it is not far off from the trajectory of the secular bull market of the 1960s and 1970s. That would entail an over 4x advance, 4x advance, over the next roughly 4.5 years, equating to a 5x move in GDX and potentially a 6x or 7x move in GDXJ. Bonus figure 3 provides more evidence that the secular bull market in bonds ended during COVID-19. There was a blowout in nominal and relative inflation assets. From the 2007 to 2008 peak, inflation assets increased by roughly 50% to 60%. During the same period, inflation assets tripled. Side note, we should correct ourselves rather. Deflation assets tripled. My apologies for that. Moving on, let's take a look at bonus figure 4, which is one of my favorite charts. It plots the energy sector's weighting in the S&P 500 over the past 100 years. I really love these 100-year charts. The weighting is not far off of the all-time low during COVID-19. The major peaks align with the peaks in commodity prices, 1951, 1980, and 2011. Our work focuses on gold and silver, but the secular trend in precious metals aligns with the energy sector. This sector also outperforms and can perform well during a secular bear market in U.S. stocks. Bonus figure 5, courtesy of RBC Capital Markets and FactSet, plots the enterprise value to EBITDA valuation for gold-focused producers and silver-focused producers. The data is from the past 11 years, which marks most, but not all, of the secular bear market in precious metals. Recall from lesson number 7 that gold stocks have been valued for mostly 5x to 10x. Silver-focused companies and producers trade at a higher valuation due to the scarcity of pure silver deposits or mostly silver deposits. During the past 11 years, the valuation for silver-focused producers has ranged from 7x to 14x. Bonus figure 6 shows the debt-to-income ratio for consumers, corporations, and the government during 3 recent time periods. I have a pet peeve about individuals forecasting a repeat of the crashes experienced in 1929 and 2008, when conditions today are materially different. The debt and leverage in the U.S. financial system have essentially been transferred from individuals, households, and corporations to the government. Since the end of 2007, the debt-to-income ratio for the largest corporations has plummeted and also decreased for consumers. On the other hand, the debt-to-income ratio for the government has nearly tripled. In bonus figure 7, we plot silver and silver against the S&P 500. Chart is inverted. The S&P 500 is trading at nearly 200 times silver. At the epic inflationary peaks of 1920 and 1980, the ratio was 6x and 3x, rounding up. The ratio was 16x and 28x at the other inflationary peaks, 1950 and 2011. This is another excellent chart, this is bonus figure 8, which is another excellent chart from Jury and Timmer at Fidelity. Great follow on Twitter, by the way. The chart is similar to the one in lesson 2 but is on a different scale and has more annotations. It compares the current secular bull market in the S&P 500 to the ones in 1982 to 2000 and in 1949 to 1968. The chart argues we are ripe for a secular turning point in the next year or two. Bonus figure 9 plots the forward price-earnings ratio for the S&P 500 and its ensuing 10-year return. When the PE ratio has been this high, the forward 10-year total return for stocks has essentially been positive only once. It is only 1% per annum. Bonus figure 10 is from Francis Hunt, chartered market technician and an MBA at the Market Sniper on Twitter, who we have interviewed, by the way, multiple times. This chart plots the S&P 500 divided by the currency in circulation. It has reached a level commensurate with the previous two secular peaks and 1937. The extreme overvalued line serves as an excellent long-term sell signal, while the extreme undervalued line serves as an excellent long-term buy signal. Bonus figure 11 shows an inverted view of gold against the 60-40 portfolio. Gold is the denominator in this calculation, with the 60-40 being the numerator. The blue lines represent the nominal lows in gold and the start of the portfolio's breakdown move against gold. Note the importance of the 40-month moving average. See those blue arrows. Again, note the importance of the 40-month moving average in the context of the breakdown below the trend lines in 1972 and 2002. The ratio has already failed twice in the last 12 months when testing the 40-month moving average. And as we know, at present, because of the last couple months, it's completely broken down. That is a negative signal. Master of the obvious here. And again, this is super positive for gold and precious metals. Bonus figure 12 from RBC Capital Markets and Bloomberg plots the price to cash flow and enterprise value to EBITDA valuations for the S&P TSX Gold Index of gold stocks. In lesson 7, I had to manually calculate and estimate a price to cash flow valuation for gold stocks because no investment bank had published anything for a few years. Side note, and as we went to publishing, all these valuation charts started coming out. So this chart became available just as we went to publish our book. The price to cash flow valuation is currently around 8 times, and the enterprise value to EBITDA calculation is slightly above 6 times. Recall that the price to cash flow valuation has historically ranged from a low of 6 times to as high as 25 times. The valuation remains low, but it is well off the record lows of 2013 and 2015 when it was below 6x. During the secular bear market, the enterprise value to EBITDA valuation ranged from 5x to 10x. Side note, right about now, based on the same chart, gold stocks are trading at about 9x, 9 times cash flow. And forward, the entire year, they're trading at about forward 7.5 times cash flow, times 2025 full year cash flow. That wraps up the end of our bonus lesson here with a bunch of additional charts. Thank you so much for tuning in. We hope you learned a lot in this first iteration of the Daily Gold University. We will have plenty more on the way in the future. And as always, leave a comment below the video. You can let me know which lesson was your favorite, which lesson did you not like. Any other comments and feedback, we would love to hear from you. Thank you so much for tuning in. Again, hope you learned a lot in this video, in all of our videos in the Daily Gold University. We'll see you next time when we restart a new series in the Daily Gold University. Thank you.